So there are 7 key accounts that I think you need in order to organize your life well for retirement. And all 7 of these accounts I'm sure you have heard of. There's nothing I'm going to blow your mind with today on that front with any special crazy accounts. But knowing about these accounts is one thing, and knowing how to use them well and use them cohesively so that they're working together is another thing. So today I just wanted to quickly walk through an overview of these 7 accounts since I'm sure most of you have heard of them. I wanted to walk you through common mistakes that people often make with these different accounts, and then also wanted to provide you with some different strategies that you can be thinking through and utilizing to help maximize these accounts for your retirement planning. And knowledge is good, but real wisdom comes in the application of your knowledge. And stewardship is what matters. So that's why I'm making this video here today, to help you be a good steward with the resources that God has given you. And of course, everything I'm going to walk through today is not personal financial advice for you, just educational good things to be thinking through. So you guys probably didn't think I was going to be starting this basic, but the first account is the spending hub of your retirement. It's your checking account. So just your everyday checking account at the bank, but this is the spot where you're going to be making all of your purchases from. So this is the step one place to be utilizing well in your retirement. Second account is a high yield savings account. And I'm not just talking about your everyday savings account at the bank. As you know, that doesn't pay any interest. That doesn't typically give you a couple cents every now and again, but I'm talking about a high yield savings account, not something that's going to make you rich, but something where you'll be able to make, I would say, a couple hundred, couple thousand extra dollars per year with the interest rates on those. A common mistake here and a draw that these accounts can have, especially when interest rates are good, is that people can tend to leave more money in these high yield accounts than what is optimal for them because they're getting a quote unquote good rate on that investment, when in reality they would be faring probably a bit better getting that excess money invested. I'm talking excess above and beyond what would be in either your emergency fund in that high yield account or in your first bucket, so a year to 2 year of retirement expenses in that account. Next up is your health savings account. I'm sure you've heard people say it's the triple tax advantaged account. It has a lot of benefits. You get the tax deduction on the money you put in. That money grows tax-free. You can take that money out tax-free if you use it for qualified medical expenses. Really, really helpful account. When going into retirement, helpful as you're going to be having more medical bills, and money from the HSA can actually be used to pay Medicare premiums as well. And a big mistake here with the HSA that a lot of people don't know is when an HSA is passed on to your heirs. So I'm not necessarily saying spouse to spouse when it goes from one spouse to another spouse on the first spouse's passing, not a taxable event, but when both spouses pass, HSA gets passed to, say, a child. In the year that the child inherits that HSA, the full value, the full fair market value of that HSA is taxable to the child in that year. So could create a bit of a hassle there for the child, say if they're in a high tax bracket situation. Of course, they're inheriting money, so not a bad thing, but not necessarily the most optimal from a tax perspective. So something to be aware of that I don't find many people know about HSAs. Next up, I'm guessing this is your workhorse for your nest egg, the bulk of your retirement savings. It's your work retirement plan, so your 401k, 403b. So of course you've been putting money into these accounts, getting that tax deferral, so it's been lowering your taxable income along the way. But once you get into retirement, this money is going to be fully taxable to you at that time. So something to be aware of here is down the road, there could be a big tax bomb or a tsunami of required minimum distributions coming down the road. So that is something to be aware of with your 401k, 403b as you're transitioning into retirement. You want to make sure you're being intentional along the way to help mitigate maybe some unnecessary taxes down the road. Fifth account here is a traditional IRA. So this is taxed the same way as your work retirement plan, the 401k, 403b, so pre-tax account. fully taxable to you down the road. Some of you may have been consolidating old 401ks into your IRA along the way. And for most people, it does make sense when you are going to retire to move your 401k into an individual retirement account. That way you have more flexibility. Next up, we have your Roth IRA. So these are the accounts where you put money in that's already been taxed. That money is going to be growing tax-free, gives you a lot of flexibility from a tax planning perspective. And there are contribution limits to the Roth IRA, but you can strategically get more money into them by doing Roth conversions, doing some of that tax planning along the way if that makes sense for your situation. And last but certainly not least, the seventh account for you to help organize your financial life going to retirement is the taxable brokerage account. This is going to be your most flexible account. It's taxable, so it doesn't have special tax treatment, I guess, in a sense, like your IRAs. So you put $100,000 into a brokerage account, grows to $150,000. You take the $150,000 out. That $50,000 is going to be taxed at capital gains rates as long as you've had that money in there for a year. This type of account is so important for tax efficient withdrawal strategies, for helping you bridge gaps if you're going to be retiring early before 59 and a half when you have access to those retirement accounts, and before you start taking Social Security. This is really a powerhouse account to give you a lot of planning options into retirement. And what a lot of people overlook with this account is just the existence and usage of this account. A lot of people focus really hard on building up their 401k, on getting their Roth IRA set up, and those are both really great, but then they maybe don't know about or forget about this taxable brokerage account and utilizing it along the way to give them some of that increased flexibility. So that's just a brief overview, all the different accounts. Now I want to run you guys through some different strategies to make sure that you're optimizing these different accounts and to make sure that they're working really well together. So with your checking account, really helpful just to make sure you're keeping a month to 2 months. This is going to be a bit more personalized depending on you and your situation, but you want to keep at least 1 month, maybe up to 3 months or so worth of expenses in that account. You don't want to be delayed if something comes up, having to wait on money being transferred. I know a lot of times that it's pretty easy to transfer money from, say, a high yield savings to your checking, but keeping a little bit of a buffer in your checking account helps to make things a bit easier for you, I found. Your high yield savings account, this is where you want to have money allocated for your bucket strategy. Just a brief overview of the bucket strategy. You typically want to have 3 buckets, so have money set aside in very safe non-volatile assets like cash in your high yield savings account. You want to have money set aside in a middle bucket that can maybe get a bit more of a return than cash, so that's typically your bonds. And then you want to have a third bucket that's typically set up for long-term growth, so that is the stock portion of your portfolio typically. So the high yield savings account is a great spot to have the money for your first bucket. It has that better interest rate, and then you have money that you can be pulling from if there is a market downturn, a safe spot to be pulling money from. And like I briefly mentioned earlier, a mistake to avoid here is you just want to make sure you don't have too much money in that high yield savings account. I know that it can feel really good for you to have a lot of safe money and you'd be getting what feels like a good interest rate, but you actually are missing out on a lot of long-term gain if you have that money set aside in cash that you don't necessarily need to be. And that can present some real challenges to you down the road if your overall portfolio isn't keeping up with inflation and you in turn are actually losing some of your purchasing power, maybe having to cut expenses down the road. So we want to avoid that by having these low risk accounts having too much money in them. Next up here, your HSA. This is going to be a powerful tax planning tool for you. You can be utilizing it to bridge to Medicare if retiring early, so you can be paying for medical expenses, be paying for your healthcare premiums from that. And then once you are of Medicare age, using it to pay Medicare premiums, other out-of-pocket expenses. I mean, you really just want to be using this account to pay all of those medical expenses, as that money is going to be coming out tax-free. Another thing with the HSA, once you are 65, you can start using the HSA as if it were an IRA. So you can use the money there for non-medical expenses. It's just taxed as an IRA or a 401k. So that money will come out and be fully taxable. That is an option that is good for you to be aware of, but not an optimal move as far as using that HSA for what it is designed for. And then then with you optimizing your 401k IRA, Roth IRA, if you still have time before you are retiring, you want to do a good job of making sure you have the right amount of pre-tax contributions versus Roth contributions. Maybe you have a mix of both, or one or the other makes more sense for your situation. You just want to take a look, make sure that you are being intentional about that. If you're a higher earner, you're earning more than the threshold for being able to contribute to a Roth IRA. Maybe you're doing backdoor Roth IRA contributions so that you can still get money into that Roth IRA to grow tax-free. Very important for your planning and flexibility down the road. You don't want to overlook if you only have one spouse working in your household. Well, that other spouse can be contributing to a Roth IRA or IRA as well. They get spousal contributions even if they're not working. So you want to make sure you're taking advantage of those along the way as well. And then if you're in retirement, you want to make sure you are doing the long-term tax planning necessary. So looking at Roth conversions on if they can make sense for your situation. If you're retiring early, you want to really make sure you're taking advantage of that sweet spot after you're working so that income is off the table before you start taking Social Security. That time frame can be a really great place to be doing those Roth conversions efficiently and really effectively as well. So, and lastly here with that taxable brokerage account, what you want to be doing to maximize it and maximize your retirement picture. You can be utilizing the money that's invested in that brokerage account to help supplement your income without maybe necessarily bumping your tax bracket, since those distributions from the brokerage account are going to be taxed differently. That account will also help you to have more control over your gains and losses. It's a very tax efficient vehicle because you can sell individual positions and realize gains if that's helpful for the situation, do some gains harvesting, or do some tax loss harvesting, harvest some losses if you were having some bigger gains that year. That can be a helpful piece just to help your picture be a bit more tax efficient. And then another piece to the puzzle that people avoid with their investment accounts overall is they view them as separate pieces to the puzzle instead of viewing all their different investment accounts as a whole pie. And what I mean by that is if you want to have a 60-40 portfolio where 60% of your portfolio is in stocks, 40% is in bonds, that doesn't mean that you have to have your traditional IRA or 401k, your brokerage account, and your Roth IRA all invested in a 60-40 portfolio. You can have those different accounts invested at different proportions according to how tax efficient these different types of accounts are in order to get that full 60-40 picture. And that's actually what I would recommend to make things a bit more efficient for you from a tax perspective. For example, say your IRA or 401k, since that money is going to be fully taxable once it comes out, maybe that's where you want to put the pieces of your investment picture that aren't going to be appreciating as much. Maybe that's where you put more of your bonds because those are going to grow less over time than the stock piece of your portfolio. So that piece growing less tax coming out in the long run. Whereas with your Roth IRA, with your brokerage account, that is maybe where you want some of your higher growth assets, because for the Roth, that money is going to be coming out tax-free. For the brokerage account, capital gains rates typically much more favorable, and you have more control over realizing gains and losses in that account. So I know I've thrown a lot at you there, but again, it's one thing to know about all these different accounts, but it's another to really sit down and make sure that you are utilizing all of them well as a whole cohesive plan to make sure that you are set up well for retirement. Having a successful retirement is not just about your investments or getting the best investment return. It's about having a really great overall investment plan, like I was just talking about, having a plan on how you're going to turn all of those investments into an income for you that's going to last your whole retirement, and then having a tax plan. Make sure you're doing all of those things as tax efficiently as possible, because I'm sure you're a great person. You do want to pay your fair share in taxes, but I haven't met anyone yet who wants to give the IRS a tip. So we want to avoid doing that if we can. So I believe that we're all called to manage well what God has entrusted to us. So having a plan in place, like how we're going to optimize all 7 of these accounts and how they're organized well, is a great way to be a good steward. So I hope this video here was helpful for you. Please make sure to like or to leave a comment below. Please share any follow-up questions that you have, or if it would be helpful for you to walk through your specific situation, make sure that these 7 accounts for you are organized well so that you're set up well for retirement. You can click in the link below in the description to set up a free retirement planning session with myself, and we can walk through your situation and make sure that everything's set up well, that you're being a great steward. So thanks for watching this video here. I hope you have a great rest of your week, and we'll see you in the next video. Take care.